The doors blasted open with a thunderous crack that rolled through the corridor, voices bouncing off the walls, while cameras snapped and flashed like a barrage of artillery. Out from the cloistered chamber of a high-level briefing erupted the Treasury Secretary, tie twisted, documents clenched in his fist, his face an angry crimson blaze. Scott Bessant didn't merely step into the hallway, he surged forward like a soldier charging into combat. Reporters collided toward him in a frantic wave, but he carved through their noise with just 5 razor-sharp words that froze Washington in mid-breath. "We sent the letters. 100. In a heartbeat, the gravity was understood. These weren't simple correspondences. They were blunt instruments, mass-forged threats built not for conversation but for domination. No courtesy. No negotiation. No middle ground. Only a stark demand: restructure trade on U.S. conditions or endure tariffs reminiscent of the Great Depression's darkest years. Bessant confirmed that these letters would catapult tariff rates back to April benchmarks, some soaring to a crushing 50%. Yet almost immediately the contradiction was glaring. Not a single one of those nations had agreed to any dialogue at all. Vietnam, Korea, Mexico, yes, their economies depend heavily on access to American markets. But most recipients stayed silent. No answers. No gestures. No signs of distress. That quiet was not hesitation, it was deliberate. Bloomberg's global trade data unveiled the arithmetic no slogan could deny. Over 63 countries on Bessant's list already trade more volume annually with China or India than with the United States. Cold numbers cut through rhetoric. So why would these governments surrender to one-sided bargains written in Washington when they are already embedded in smoother, cheaper corridors tied to BRICS? This wasn't rebellion. It wasn't defiance. It was indifference, hard, calculated indifference. And that indifference, landing at this exact moment, carried volatility like dry tinder waiting for a spark. Trump had already postponed the fuse twice. July 7th had been the original detonation. Then August 1st. Now Bessant framed the deadline as a signal, not a fixed date. But global markets do not price in signals, they demand certainty. And the reaction was immediate. The S&P 500 tumbled 2.1% in a single session the moment Bessant's words appeared on Bloomberg screens. Investors weren't fleeing tariffs, they were fleeing disorder. That turbulence was magnified by a staggering $3.4 trillion tax expansion passed mere weeks earlier, igniting fears of debt-fueled inflation embedded into federal policy, like dynamite wired to the floorboards. There was no clear red line anymore, only elastic warnings, collapsing timelines, and international partners who no longer bothered to pick up the phone. Then, as if one battlefield wasn't enough, a second front opened: BRICS. Trump's latest directive slapped an automatic 10% penalty tariff on any nation aligned with anti-American BRICS policy. But what exactly does anti-American mean? The definition was left deliberately ambiguous, hanging like a loaded trap. Is it de-dollarization? Is it joint infrastructure funding? Is it multilateral settlements outside the dollar? By that sweeping logic, even Germany, one of America's NATO allies, could fall into Washington's line of fire simply for settling trades with China in yuan. Brazil might be struck with double duties just for joining the BRICS Reserve Asset Initiative, a program designed to clear commodities like oil and lithium in a collective non-dollar mechanism that hasn't even launched yet. This wasn't a boundary, it was a moving bullseye painted on anyone who dared transact outside the dollar's shadow. And here lies the irony so thick it cannot be ignored. The United States itself spent decades constructing and policing the very economic order it now seeks to punish. The WTO, the IMF, swift bilateral trade accords, these were American creations designed and enforced under its watchful eye. But as BRICS rises into a parallel order founded on non-dollar settlements and commodity-backed trade, Washington's own machinery is being flipped against it. The interdependence it once celebrated has hardened into a restraint, binding the U.S. in its own net. The numbers speak like cannon fire. In 2000, the G7 commanded nearly 70% of global GDP. Today, their share has shrunk to under 43%. In the same span, BRICS has leapt from 18% to 34%, and the trajectory is still upward. The IMF projects that by 2029, China alone will constitute nearly 19% of global GDP. Add the likely accession of Indonesia, Egypt, and Saudi Arabia, and by 2026, the bloc could hold sway over almost half the world's productive capacity and a majority of its critical mineral reserves. So what muscle does 100 tariff letters really flex against that backdrop? What leverage remains when global supply chains and trade routes have already shifted east? Washington insists that the sheer size of the U.S. consumer market still grants unmatched power. But leverage is like metal. It corrodes, it bends, it rusts. And the ground beneath Washington's posture is shifting faster than the ink can dry on those letters. Leverage is never a one-way street, and when it comes to global trade, that truth lands hardest on the United States. America's import machine runs on a staggering $3.1 trillion worth of foreign goods each year, according to the Census Bureau. Despite years of tariff skirmishes and fiery rhetoric, China still stands as the indispensable supplier, filling American shelves and assembly lines with electronics, batteries, pharmaceuticals, and auto components. Tariffs, then, are not a clean weapon. Yes, they can bruise foreign exporters, but at the same time they inflict wounds on domestic producers through rising input costs, tangled logistics, and retaliation that cuts back just as hard. And retaliation isn't some distant threat waiting on the horizon, it's already here. In 2024, BRICS trade volumes soared to 4.6 trillion yuan, or about $650 billion in US terms, a year-on-year increase of 5.2%. That surge came despite every possible headwind. Europe wobbling on the edge of recession, US interest rates climbing, and global demand sliding downward. If such growth can happen under those conditions, imagine the effect of even modest realignments triggered by new tariffs. A single executive order from Washington could shove allies into redirecting supply chains toward BRICS countries, and once those new channels are dug, history suggests they rarely reverse. The evidence is everywhere. According to Reuters, more than 37 countries have built formal settlement pipelines for cross-border trade in yuan since 2023. The Gulf Cooperation Council gave the green light for oil contracts priced in Chinese currency. Brazil and Argentina already clear over 40% of their bilateral trade with China outside the US dollar. What was once theory has become an operational rollout. The direct consequence is a gradual, persistent decline in demand for dollars, and with it, weakening appetite for US treasuries. Bloomberg's numbers spell it out. Foreign purchases of treasuries have fallen by $289 billion over the past year, with BRICS and their closest partners leading the retreat. China alone cut its holdings by $12 billion, its sharpest drawdown since 2016. The logic is simple. Less trade in dollars means fewer surplus dollars to recycle into American debt. As Treasury demand falls, U.S. borrowing costs climb, and the tariff boomerang slams back toward Washington. But Beijing isn't simply pulling away, it's repositioning. The People's Bank of China has been quietly building a war chest of trust in the form of gold. In June alone, it added 70,000 troy ounces, pushing its 8-month accumulation to more than 34 metric tons. This shift isn't about seeking yield, it's about hedging against vulnerability. Gold doesn't bend under U.S. political risk, sanctions threats, or congressional debt ceiling theatrics. That is precisely what makes it irresistible to BRICS nations. The irony could not be sharper. The same metal once stripped of monetary status by Washington has been resurrected as a shield and weapon by Beijing. The pivot is not confined to Asia. Even Europe, traditionally anchored to NATO and U.S. financial leadership, is edging in a new direction. In a move that raised eyebrows, a German church pension fund allocated $50 million to a Hong Kong-based China equity fund, the Financial Times reported. The official rationale was exposure to undervalued Chinese technology and industrial growth. But beneath the numbers lies a far more symbolic message. A Western NATO-aligned institution chose to park capital in a market openly branded adversarial by Washington. This is how subtle the transition unfolds. While American tariffs cast shadows, BRICS quietly absorbs Western cash. Investors have taken notice. Year-to-date, the Hang Seng Index has surged 21.3%, outpacing the S&P 500, which managed just 6.7%. Wall Street is not crumbling, but global capital is clearly diversifying. Traders no longer trust American fiscal and trade policy to remain stable over the long run. When volatility ceases to be episodic and instead becomes structural, yield alone can't hold investors. They chase systems, not spikes. That's why China's next move is particularly provocative. Bloomberg reports Beijing is considering expanding its southbound Bond Connect program, potentially unlocking up to 1 trillion yuan, roughly $140 billion, for outbound investment. At first glance, this might look dollar-friendly, opening the door for Chinese institutions to buy U.S. corporate debt, euro bonds, even treasuries. But the real aim, according to sources at the People's Bank of China, is reciprocity. The vision is to transform Hong Kong into a fully fledged financial ecosystem, one that not only attracts foreign money, but also allows Chinese capital to flow outward freely. The Hong Kong Stock Exchange is already preparing to list more BRICS sovereign bonds. Piece by piece, an alternative to Wall Street is being assembled, an ecosystem that can thrive independently, and one day, directly in opposition to American dominance. Meanwhile, back in Washington, Trump's economic playbook risks intensifying the feedback loop. His most recent tax legislation tacked another $3.4 trillion onto the federal deficit, according to the Congressional Budget Office. Inflation projections rose by 1.7 percentage points for 2026. But beyond the macro numbers, the distribution of gains and losses is politically explosive. The Joint Committee on Taxation calculates that the top 20% of households will enjoy a 2.3% income boost, while the bottom 20% will actually lose 2.3%. So as tariffs push consumer prices higher, it is the poorest households that see their purchasing power collapse, even as wealthier Americans shift capital offshore to hedge risks. And when the middle class stops spending, the entire economic engine sputters, retail freezes, growth slows, and small business investment withers. We've seen this before. It echoes the 1970s, when inflation spiraled under oil shocks and stagnant growth, only now the drivers are tariffs layered on globalized supply chains. The Peterson Institute warns that if August tariff hikes go through, inflation could jump between 15 and 20%. Such pressure on household budgets could easily become intolerable. And yet, while the U.S. is tightening, the BRICS bloc is cutting rates, expanding credit, and subsidizing trade. The contradiction is stark. America constricts while its competitors accommodate. The deepest irony? The very architecture enabling BRICS to challenge the U.S., trade corridors, digital payment rails, alternative currencies, infrastructure models, was pioneered and exported by Washington during the globalization wave. In trying to lead the world, the U.S. built the toolkit others now use to unseat it. This isn't a coup, it's a remix. If the United States continues to respond with threats instead of competition, it won't be tariffs that isolate it. It will be the silent gravitational pull of a new trade and financial order. The open questions remain. Will BRICS ever step back? Will Trump adjust course? Or are we now witnessing the irreversible fracture of the old system that has defined global commerce for decades? Share your thoughts in the comments. Don't forget to like and subscribe, and check out our next deep dive waiting for you now.